Good day, investors. In this video, we're taking a closer look at Celestica following its Q1 earnings release. The company delivered a very strong quarter with impressive growth, improving profitability, and an upward revision to its full-year outlook. But despite all of that, the market reaction was actually negative. So what's going on here? In this video, we'll go through the key results, analyze the underlying fundamentals, take a look at valuation, and finally, I'll share my view on whether Celestica stock represents an attractive investment opportunity after these earnings. But before we begin, don't forget to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. So let's get straight into the earnings, because this was a massive quarter. Revenue came in at $4.05 billion, up 53% year over year. That is extremely strong growth, especially at this scale. EPS came in at $1.83, up 147%, and adjusted EPS was $2.16, up 80%. Now what's even more important, margins are expanding at the same time. Adjusted operating margin reached 8%. So what we're seeing here is not just growth. This is profitable growth with operating leverage. Now the key question is, what is actually driving this growth? If we take a look at the segments, the connectivity and cloud solutions business grew 76% year over year. And that is where almost all of the growth is coming from. Now breaking that down further, enterprise, which includes AI servers, grew 101%. Communications, which includes networking, grew 69%. So what this clearly shows is the demand for AI infrastructure is absolutely exploding. Meanwhile, the ATS segment was basically flat. So this is not broad-based growth. This is a very clear shift toward AI and data center demand. Now, beyond just growth, the quality of this business is also improving significantly. If we take a look here, adjusted operating margin expanded to 8%, and adjusted EPS increased to $2.16. But what really stands out is this. Return on invested capital is nearly 50%. That is extremely high. It means the company is generating very strong returns on the capital it's deploying. So this is not just a growth story, this is a high-return, scaling business. Now let's quickly look at cash flow. The company generated about $356 million in operating cash flow, and roughly $138 million in free cash flow. So overall, cash generation remains solid. But what really stands out is this. CapEx jumped to around $230 million in Q1. That's a significant increase. And this is important because this is growth investment, not just maintenance. The company is clearly expanding capacity, which tells you management is expecting demand to remain strong going forward. And it reinforces the idea that demand for AI infrastructure remains very strong. Now let's quickly look at the balance sheet. The company is in a very strong financial position. Net debt is only around $341 million, and leverage is just 0.6 times. They also have roughly $2 billion in total liquidity. So overall, this is a company with strong growth, but also a very solid balance sheet. Now, let's look at guidance, because this is where things get really interesting. Starting with Q2, revenue is expected between $4.15 and $4.45 billion, and adjusted EPS up to $2.34. So the strong momentum is clearly continuing, but the real highlight is the full-year outlook. The company raised its 2026 revenue guidance to $19 billion, up from $17 billion, and adjusted EPS was increased to $10.15 from $8.75. That is a massive upgrade. And this is key. Companies don't raise guidance like this unless they have strong visibility, especially in a business like this. So what this tells us is demand, especially from AI and hyperscalers, is still accelerating. Now looking beyond just this quarter. The long-term story here is very clear. The company expects continued growth in AI and data center demand through 2026 and into 2027, especially driven by AI and machine learning compute. next-generation networking like 800G and 1.6 terabits, and ongoing demand from hyperscalers. In fact, the connectivity and cloud segment is expected to grow by around 70% in 2026. So overall, Celestica is positioning itself as a key player in the AI infrastructure build-out. Now, after looking at the earnings, let's take a look at what analysts are expecting for the stock. So currently, according to stock analysis data, the consensus rating is a strong buy, but interestingly, the average price target is around $355, which actually implies roughly 15% downside from current levels. Now, if we break it down further, the highest price target is $450, while the lowest is as low as $120. So there's a pretty wide range of outcomes here. And what this tells you is, even though the fundamentals are very strong, the stock may already be pricing in a lot of that growth. Now, if we take a look at the stock itself, Celestica is currently trading at around $378 per share, giving it a market cap of roughly $48 billion. And the stock has had a massive run, up over 4,300% over the past 5 years. That's an incredible move. Now, looking at valuation, the stock is trading at a PE of around 46 and a forward PE of about 39. So while the valuation has come down slightly, this is still not a cheap stock. And when you combine that with what we saw earlier, analysts are still expecting some downside from here. It suggests that a lot of this growth is already priced in. So when we bring everything together, Celestica just delivered an exceptional quarter. Revenue growth was very strong, margins are expanding, and full-year guidance was raised significantly, all driven by very strong demand for AI infrastructure. At the same time, the company is investing heavily to expand capacity, which suggests management expects this demand to continue. However, the stock has already had a massive run, and valuation is no longer cheap, with analysts even expecting some downside from here. So in my opinion, Celestica remains a high-quality company with strong momentum going into 2026 and 2027. But from here, the story becomes more about execution and whether AI demand can continue at this pace. So the business looks strong, but the stock may already be pricing in a lot of that growth. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.